Most of what passes for money advice today is noise, trading tips, crypto bets, side hustles that don't work. But over the past 100 years, a small set of boring rules has quietly made more millionaires than any hot stock ever has. The rules are old. They're free. And they're hiding in plain sight. Here are 7. And rule number 5 is the one almost nobody actually follows. Rule 1. Pay yourself first. The phrase goes back to a book published in 1926 called The Richest Man in Babylon. The idea is simple. The moment money comes in, a fixed slice goes straight into savings and investments before anything else, before rent, before groceries, before subscriptions. You treat your future self like a creditor that gets paid first. There's modern proof this works. Vanguard's How America Saves report showed that when companies auto-enrolled employees into a 401k, instead of asking them to opt in, participation jumped from about 50% to about 90%. Same people, same income. The only thing that changed was the order. Money got paid to the future first. That's all. Rule 2. Live below your means. In 1996, 2 researchers published a book called The Millionaire Next Door. They surveyed actual millionaires in the United States, not the ones on TV. The boring finding. Most of them drove used cars, lived in modest houses, bought groceries on sale. The wealth didn't come from a luxury lifestyle. It came from the gap between what they earned and what they spent. The bigger the gap and the longer it stays open, the more money quietly piles up behind you. Rule 3. Buy and hold the index. Every year, S&P publishes a report called SPIVA. It tracks how professional active fund managers do against the simple S&P 500. The result, repeated for decades, somewhere between 85 and 90% of U.S. large-cap active funds underperform the S&P 500 over 15 to 20 years. These are full-time professionals with research teams, and they lose to a boring index that just owns everything. The old rule is, pick a broad index fund, buy it, hold it for decades, and don't try to outsmart it. Most people who try lose. Rule 4. Reinvest the dividends. When a company pays a dividend, you can take the cash, or you can use that cash to buy more shares automatically. Hartford Funds did the math on what happens over very long periods. Their long-term analysis of the S&P 500 shows that a huge portion of total return over decades comes specifically from dividends being reinvested and compounding. Not from price spikes, not from clever timing, from small payments, automatically buying more of the thing year after year in silence. It's the quietest engine in finance, and it does most of the work. And here is Rule 5, the one almost nobody actually follows. Kill high-interest debt first. The Federal Reserve tracks average U.S. credit card APR. In recent years, that average has been sitting near 22%. Think about that. There is no legal investment that pays you a guaranteed 22%. Not the S&P, not treasuries. Nothing safe. So if you're carrying a balance at 22% and you're also buying stocks, mathematically, the debt wins. Every dollar you throw at killing that balance gives you a guaranteed 22% return. Boring. Unsexy. Often the highest return move a normal person can make. Rule 6. Buy quality once. There's a famous passage by the writer Terry Pratchett, sometimes called the Vimes Boots Theory. The idea, a poor person buys cheap boots that fall apart after one winter, so they buy them again and again, and after 10 years, they've spent more on bad boots than a rich person spent on one pair of good boots. And they still have wet feet. Quality, bought once, is often cheaper than cheap, bought 3 times. The same logic applies to tools, appliances, clothes, even tires. Buy the boring, durable version. Pay once. Stop bleeding small money forever. Rule 7. Diversify wide. In 2018, a finance professor named Hendrik Bessembinder published a paper that quietly destroyed a lot of stock-picking pride. He looked at every single U.S. public stock since 1926. His finding, only about 4% of all stocks generated all of the net market gain. The other 96%, taken as a group, just barely matched cash. Which means if you bet your retirement on 3 or 4 stocks you picked, the odds you avoided the 96% and landed on the right 4% are very, very small. The safe rule: don't pick, spread wide, own everything, let the 4% show up on its own. So that's 7 old school rules. None of them are clever. None of them require predictions. None of them sell well on the internet. But if you actually do them, the math runs in your favor. Pay yourself first. Live below your means. Buy and hold a broad index. Reinvest the dividends. Kill high-interest debt before you invest. Buy quality once and spread wide. 4 boring moves underneath all of that. Earn. Spend less. Invest in something wide. And wait. That's it. That's the entire game. Boring beats clever almost every time. If one of these surprised you, tell me which one in the comments. And if you want money explained honestly, no hype, no get rich quick, subscribe. New breakdowns every week. This was the